Hello, I'm Johanna Kirkland, and this is the first edition of my CIO Lens, where every quarter I'm going to bring you the opinions and views of our investment experts at Schroders.
Omicron is more transmissible, but that cases are mainly mild, with most hospital admissions in the unvaccinated.
The recent Omicron scare is a timely reminder that we're still in an environment of profound change, and that change extends beyond the pandemic. So, for example, over the last 25 years, I've been very much focused on the interest rate cycle. But looking ahead, the price of carbon and the transition away from fossil fuels will be just as fundamental to the market outlook.
We will put a price on pollution, and we will make sure that the energy we use is clean.
Energy transitions such as this will shape the political, economic and social order for many years to come, and is exactly the kind of disruptive trend that we're looking to navigate for you as active managers.
And it's early days, but a very encouraging set of results so far.
After a very strong 2021, we're entering a more mature phase of the cycle, where growth momentum is likely to be peaking and central banks will start to raise rates. Against this backdrop, we expect returns to be more muted from equities, but still positive, supported by corporate earnings. We see two key risks to markets in 2022. Firstly, if inflation accelerates, it could unhinge the yield curve and force central banks to raise rates more aggressively.
As grisly as today's figures are, the one thing most economists agree on is that there's worse to come, with energy price hikes expected to push inflation past 5% next year.
We actually think supply bottlenecks will be easing, which should help inflationary pressure, but we have to keep an eye on wage costs, which are starting to pick up. And at stock level, we remain focused on identifying those companies with the pricing power to withstand the hit to margins. In recent years, we compared the global economy to a wobbly bicycle, where growth was anemic and so any gust of wind could blow us off course. The pandemic essentially forced governments to put stabilisers on the wobbly bicycle. A challenge for 2022 is that those stabilisers are now coming off, and we need the private sector to step up. And unfortunately, with Omicron still in the picture, it is unlikely that we'll see a strong, synchronised global recovery, which would enable us to rotate aggressively into the cheaper, more cyclical areas of the market. So this leaves us exposed to trends which are quite exhausted, like the outperformance of the US equity market. In summary, we see more muted returns and increasing risks. This is not a time for big bets, but rather a time to diversify your portfolio.